Welcome back. In this video, we'll explain key financial ratios, including the PE and PEG ratios. By the end of this video, you'll understand how to use these ratios to evaluate a company's performance and valuation. Financial ratios are tools that help investors assess a company's performance and compare it to others. The price-to-earnings (PE) ratio measures a company's current share price relative to its earnings per share (EPS). A high PE ratio may indicate that a stock is overvalued, while a low PE ratio may suggest it's undervalued. The price-earnings to growth (PEG) ratio considers a company's PE ratio and its earnings growth rate. It provides a more comprehensive view by factoring in growth potential. A PE ratio below 1 may indicate a stock is undervalued, while a PEG ratio above 1 may suggest overvaluation. Other important ratios include the debt-to-equity ratio, return on equity (ROE), and current ratio. Each ratio provides different insights into a company's financial health. Imagine you're evaluating Apple's stock. You calculate its PE ratio by dividing the current share price by its EPS. Then, you calculate the PEG ratio by dividing the PE ratio by the company's earning growth rate. Think of financial ratios like the gauges on a car dashboard. Just as they provide essential information about the car's performance, financial ratios give insights into a company's financial health. In summary, key financial ratios help investors assess a company's performance and valuation. Stay tuned for our next video on technical analysis.